In early 2026, FICOM partnered with Absolute Engagement to survey 1,000 high net worth investors who currently work with a financial advisor. We asked them what mattered most in the process of connecting with their advisor before they hired them. The answer that came back at the top, ahead of staying in touch, ahead of sharing relevant content, ahead of helping them plan for the future, was this: my advisor demonstrated that they understood my specific needs. 74% of investors said that specifically was very important. It's the highest rated attribute in the entire study. And that's really the new growth equation. It landed harder for me than any other data point we've published this year, because most conversations in our industry right now are about the businesses themselves. Bigger is better, scale through acquisition, advisor development, efficiency and productivity, better service and better performance layered in along the way. Meanwhile, the clients we most want to serve are telling us a different story. They want proof that you actually understand people like them, and they're validating that proof across multiple digital channels before they'll ever pick up the phone. The interesting question then becomes, what does it actually look like to build a firm that can demonstrate that understanding structurally and not just claim it? That's what drew me to today's guest. Simon Quick Advisors was built to serve complex clients from day one. Two Wall Street families, the Quicks and the Simons, decided the firms available to them weren't going to work. They wanted open architecture instead of products, alternatives access instead of model portfolios, family office capabilities that came from decades of running an actual family office, not something bolted on. Peter Simon had been running his family office for close to 30 years before the two families merged in 2017. Les Quick started what became Simon Quick with his own family as client number one. The design intent was there before the firm was. Today, Simon Quick manages $9 billion. They have 34 owners, and they're aligned with clients in ways most firms describe but few can prove. Same investment vehicles, same CPAs, same estate attorneys. When the firm launches a new private equity offering, more than 30 of their own colleagues invest alongside their clients. And both founding families are still fee-paying clients today. Growth Leaders of Wealth Management tells the stories of firms driving differentiated growth in our industry. And my conversation with Chris Moore, managing partner, Mark Delato, partner and corporate development officer, and Darcy O'Brien, chief marketing officer and principal at Simon Quick Advisors, is about what it looks like to build a firm designed to demonstrate understanding, not just claim it. What I wanted to understand is how a firm designed for complexity 2 decades ago is meeting the modern investor's search behavior today, because 2 of their most recent leads found them through ChatGPT. And in our study, 15% of investors with $5 million or more in assets have already used an AI tool to help find their advisor. Simon Quick has been building for this new reality for years, not months. Simon Quick Advisors is headquartered in Morristown, New Jersey, with offices in New York, Denver, Dallas, Chattanooga, and 7 other locations across the country. The firm serves 678 households at an average relationship size of $13 million in assets. Client retention over the past 5 years has held strong at 97%. And in the 9 years since the 2017 merger, Simon Quick has tripled in size, from $3 billion in assets under management to $9 billion today, while the ownership base has expanded from a concentrated founding group to 34. All right, I want to start by doing a quick review of the origin story to sort of get to the firm's identity today. But I know that 2 Wall Street families sort of came together to build what is today the Simon Quick firm. And based on what I could read, it sort of sounded like these 2 families had decided that their existing firms and how they were managing their money weren't really good enough and they wanted to build their own. And so do any of you know sort of what they were looking for at that time and how the merger in 2017 came to be?
Sure, I can take that one. I think you hit the nail on the head, Meg. Both Peter and Les were looking for solutions for their family, and they kind of, in Peter's instance, set up West and Sons, which was the Simon family office that started at this point over 30 years ago. And Les and his brothers and his dad founded Quick and Riley, and post-liquidity event felt like the firms that were available to him were not solving all of his needs and his family's needs. And Les really kind of started what is now Simon Quick 22 years ago with his family in mind as kind of client number one. And he put up capital to start the business and build the business around what he thought families like the Quick family and other families with similar complexity would need as they, thought about creating multi-generational wealth. And Peter did the same, but Peter's needs were somewhat different than Les's because there was a single family office with a lot of family members and multiple generations that had everything from, planes, cars, boats, divorces that they needed to manage through. So it was more of a high touch kind of boutique lifestyle approach in addition to the private client experience.
And how does that family office origin story still matter today in 2026?
Sure. Interestingly enough, Peter and Les were friends through their philanthropic communities. And in 2017, Peter and Les were having conversations about kind of where their respective businesses were heading. And we decided that we needed more services in-house to offer to our high net worth client base. And Peter and his brother Bill at the time were looking for a succession plan. They were looking for a way to bring other families that weren't Simon family members into the fold. And we were very aligned culturally, and this allowed us to take a family office that was in existence for, at that point, nearly 30 years and bring that team over, those processes over, and the services that we knew worked for the family and incorporate that on the Quick side of the house with the families that we already had as clients of Simon Quick, and certainly the families that we would, attract from that point forward. And what we liked about that was we weren't creating family office services from scratch. We weren't saying, hey, we need family office services to provide more value to the clients that we work with. So we're just going to go out and hire a bunch of people and figure out what they need. No, we were bringing over a team that had been doing it for nearly 30 years for a very prominent family in New Jersey and California at the time that knew what worked, that knew what the family needed, that knew kind of, which vendors or partners they needed to leverage to get things done. And to us, that was incredibly appealing. And now we have a team of individuals. Some of the original team has since retired, but we have a team in the family office that specifically caters to kind of the ultra high net worth. And we've really benefited from having that in-house because even someone that doesn't need the services today likes knowing that if they join Simon Quick and maybe their life gets more complex, or maybe they decide they don't want to do a lot of the things that they've been doing on their own, and they want to leverage our family office in the future, they like knowing it's there. They like knowing that they can do that when the time comes. And then we have other families that have been leveraging it from day one since they became clients.
That family office capability isn't decorative. It's what makes serving the firm's ideal client possible. Simon Quick's typical client sits between $10 and $50 million in investable assets. And at that level of wealth, complexity isn't an occasional consideration. It's the whole reason a firm gets hired. What separates a firm that says it can serve those families from a firm that actually does is whether the architecture behind the claim is real. At most firms in this space, alignment with clients is a phrase used in marketing. At Simon Quick, alignment is an ownership structure. And that structure is where the story turns from what the firm was built to be to how it actually behaves in practice.
As we think about kind of the ideal client for us, it's really in 10 to 50 million, certainly. And that becomes ideal just because they can leverage all of the services and expertise that we have in-house. We're very much set up to cater to the high net worth. So the family office is just another layer of sophistication that's available to the more complex or bigger balance sheet clients that want to leverage it.
I know that at Simon Quick, one of the things that you say is that you invest alongside your clients, and that 10% of the firm's assets under management today are the firm's own capital or members of the firm's own capital. I get the sense, just based on even that origin story, that that's much more than a tagline. So what does investing alongside our clients actually mean in practice for the firm and the advisors and executives at the firm?
Yeah, so there are 34 owners of the firm. You're looking at 3 of them right here. When we say that we're investing side by side with our clients, that means that we're putting our dollars, my capital, Mark's capital, Darcy's capital, in the same investment vehicles that our clients are investing in. It also means that we're using the same CPAs, the same trust and estates attorneys. And why we're proud of that is we want to be aligned with our client base. And for example, we just launched a private equity vehicle. If we're presenting our private equity vehicle to our client base, it's really important for me to be able to say, hey, you have 30 plus Simon Quick colleagues invested in the same vehicle. So we believe in it, which is why we're presenting it to you. And that's, I think, just a powerful statement and one that a lot of firms can't always commit to. And knowing that the Simon family and the Quick family are obviously substantial investors within the group of ownership and that they remain fee-paying clients to this day is really important to us.
Yeah, you answered my next question already, which was what type of capabilities does that structure unlock? And you talked about the private equity vehicle. But when I was looking at the differentiated investment access that you offer to your clients, private equity, venture capital, private credit, real estate, et cetera, it felt to me like that investing alongside our clients was directly related to your ability to be able to offer that.
Definitely. And we were early investors in private markets. We've been investing in private markets for 22 years since our founding. What we were late to do was create a co-mingled vehicle that kind of made access easy and created a more programmatic approach. We launched that this year, and initial interest by the Simon Quick team and our client base has been really robust. And what's happened is over the years, we've developed so many great relationships with private equity, venture capital, growth equity, private credit funds and fund managers that we can invest in pretty much anyone that we want. And they'll frequently send us co-invest deals or kind of unique pre-IPO investments that we want to be able to participate in and do it in a way that the clients can benefit and not have to answer, hey, you've got 10 days to make this investment. Is it a yay or nay, right? And having a fund vehicle that can give you the asset class exposure allows us to have discretion on what goes in it. So clients automatically benefit from the access.
I was at the Tiburon CEO Summit last week in San Francisco, and there was a lot of talk about alternatives and how big are alternatives really in this space. There's so much, like so many headlines, so many companies that have popped up. They're all sponsoring all the events that like Mark and Darcy, I see you at all the time. I think that what I'm hearing from executives across the industry is that investment into some of these alternative asset classes is really not as dominant as the headlines might portray it to be. However, I think for a firm like Simon Quick, who's been doing this for 22 years, and the types of clients that you serve in sort of that 10 to 50 million assets under management range, clearly it's a different story for your firm than it is for the broader industry. Would you agree with that?
Yeah, I would agree. It's it's now, I think, at a point where if you're a high net worth individual and you're working with an advisory firm, it's kind of table stakes to have access to alternatives. And if you don't have an in-house team or, decades of experience doing it, it's really hard to provide that access from day one. And a firm like ours has been in the alternatives world for so long that we feel very fortunate to have the network that we do, the team that we do, and certainly the results that we've had with exposure to those asset classes. A lot of, I think, the asset growth is also a function of, the sovereign wealth funds and pension funds and endowment foundation world getting a whole lot bigger, but also the really ultra wealthy families seeing kind of continued growth in their capital base. It's easier to be a private company today than a public company. It's just a lot less fun being a public company than a private company.
And Meg, I would just add to something Chris said during our origin story around what Peter Simon and Les Quick saw as a hole in the marketplace because of their experience serving on charitable boards. They took this model of, endowment and foundation management, right? Or you're taking this pool of capital and investing it across different managers and asset classes and applying that to the high net worth individual space. And they found that where the players they were going to on Wall Street were offering more of a product-based approach. They wanted to create this sort of open architecture approach and bring that to the individual investor.
What Simon Quick built in its first 13 years wasn't a growth story. It was a foundation, a family office capability that came from decades of running an actual family office, an alternatives platform built during a period when access still meant something, an investment philosophy borrowed from the endowment world and translated for individual families. Those decisions were made when the industry wasn't paying much attention to this segment. But over the past decade, the segment has become the industry's most sought after client. And that is where Simon Quick's growth story really starts. Let's talk a little bit now about the growth trajectory for Simon Quick. You've had some pretty awesome recent acceleration. And so I'd like to dig into some of the channels that are driving your recent acceleration and growth. I think from what I understand, when in 2017, when the merger happened, was the firm at about $3 billion in assets under management?
I think just shy, but somewhere in that neighborhood. Yeah.
Okay. So, and then in 9 or less years' time, you've tripled that to the $9 billion firm that you are today. So, and any of you can take this one. What are some of the, or all of you can take it. What are some of the key inflection points in that time? 2017 merger, roughly $3 billion to tripled today.
I can start, and I'm sure Mark and Darcy have plenty to add. The two that come to mind for me are really the Simon merger in 2017 was big for us because I think it put us on the map as providing family office services and really as a sophisticated partner for the ultra high net worth. The Simon name is well known, certainly through West and Sons, but also West Ray, which was the initial kind of private equity buyout firm that the Simons founded. And that was a big deal for us, right, to have a merger at that time and one that brought additional services and very sophisticated clients to us through the single family office that the Simons were overseeing. The second event that I would say had a lot to do with kind of the growth that we've seen over the last 7 years was in 2019, we expanded our ownership base substantially to include more Simon Quick colleagues on the cap table. And it was really a function of, hey, we have all these great people here and we feel very proud of the culture that we built. And the team is really what's driving us forward and delivering for clients and delivering for their peers. We don't want an organization that is owned by one or two people. We want to be able to bring other owners into the fold and row the boat together, right? And we think certainly be able to do a lot more if we're doing it together than versus just keeping equity in the founder's hands. And I give Les enormous credit and Peter enormous credit for that, because they had that vision early and they were very willing to create opportunities for the rest of us to own equity and to build the business with the belief that a smaller piece of a much bigger pie was better than a bigger piece of a smaller pie. And we've seen exponential growth in those 7 years, and having the right people, driving us forward and motivated in the same ways because we're aligned as owners together was a big cultural shift for us, and one that we feel, very fortunate to have participated in.
Yeah, just building off of that too, I think when you look at that first cohort of owners, a lot of them had been people like Darcy, had been here for some time, and we're really a big part of and key contributors to what we were, what we envisioned Simon Quick could be. And as Chris mentioned, having that alignment, we probably will mention alignment several times in this conversation, but having that alignment internally amongst the people here, I think was a key inflection point in our growth cycle. At that time, we went from, a very concentrated group of about 5 to then 15, seemingly overnight. And then fast forward to today, 34 owners. And some of those have been, homegrown, and some of those have been through inorganic, but ultimately all of them are, key contributors to what we're building here.
There is an inflection point in the life of an advisory firm where the growth math changes. For a long time, referrals from happy clients are enough. But as a firm grows past a certain size, the same referral rate against a bigger denominator starts to compound more slowly than the firm needs to. The firms that keep growing at scale are the ones that see that inflection coming and start building the next channels before they need them. What is interesting about Simon Quick is that they didn't just add one new channel. They rebuilt the entire growth engine as something that runs on more than one input at a time. And Mark, talk me through over that period of time that we're referencing, sort of, 2017 merger to today. How has your role specifically, corporate development, M&A, inorganic, played, how has it played a role in the growth? And how are you sort of balancing organic versus inorganic at Simon Quick?
Yeah, that's a great question. And, I would say as important as my role is, it's actually the other way around. It starts with organic growth. And you have to be really good, I think, or great at organic growth first before you can go down the road of inorganic growth. Inorganic growth has been certainly a key contributor to our overall, but if you can't grow organically, that's not going to result in successful outcomes, 5-10 years down the road. And I think that's the way that we think here, is long-term thinking. So I'm actually going to hand the baton back over to Chris to just talk about, how he's been leading organic growth and where I think, it sets the foundation for our success.
I think in our early years, we're entirely dependent on organic growth for the firm's ability to grow. And we did that through relationship-based sales approach, right? It was leveraging our founders network, leveraging our teammates network, and then just making clients really, really happy so they send other clients to us. And that worked really well for a long time. And then we kind of got to the point where we said, hey, this is great, but we're getting to a size now where it's going to have less of an impact every year incrementally because the denominator is so much bigger. And having the same people, even with the same success rate, is just going to have less of an impact. And we kind of said 2 things need to work for us going forward to achieve our growth goals. One is we have to focus on inorganic growth too. And that was kind of what Mark's initiative really was. I guess it was probably 2018, 2019, where he started spending a lot of time on inorganic growth, and I'll let him talk about that in a minute. And then the other was, what are we going to do to lean into organic growth, right? And the way that we think about organic growth is there are multiple channels to organic growth. One is just clients being happy because their advisors are doing an A+ job for them, and those clients are referring other clients. The other is individuals at Simon Quick going out and creating, new contacts for the firm that we can talk to and leverage COI relationships to bring in, new clients. And then the big initiative that we did last year was we hired a head of client growth who has come in and helped us coach and train advisors and really help us think about how do we get more successful at bringing more people to Simon Quick as leads, and then helping them through the process to determine if Simon Quick is the right home to help them and their families. And he was a huge hire for us, and he's got decades of experience at JP Morgan, at Goldman Sachs, and Fidelity prior to that. And he's been able to bring kind of a institutional approach to thinking about organic client acquisition. And then the last one I'll let Darcy really walk through is the marketing team and focus has really evolved in a way that's been immensely beneficial to Simon Quick and how we're growing and building the business and the brand. And I'll let Darcy talk about that.
Yeah, when we think about our growth, we're really thinking about what are the channels that we are bringing in new clients from. And so, as Chris mentioned, over the past 20 years or so, we had kind of developed a nice referral engine. So the leads that were coming into us through referrals were really consistent, and we were feeling really strong about that. And our client team has achieved a 5-year average of 97% client retention rate. That's really huge for us because you can't fill a bucket if there's a leak at the bottom, right? So getting that referral engine going and that client retention number really strong is sort of the foundation. And beyond that, we asked ourselves the questions like, okay, this is working for where we are today, but what do we want this firm to look like in 5, 10, 20 years from now? And that's where we realized we had some building to do, right? So those inorganic opportunities, we needed to create a true channel and dedicate someone like Mark to the initiative and really be filling up that pipeline in a way that we had been doing more collaboratively, I would say, prior to that point, right? Sort of like we didn't have one single person accountable for it. We had a few people triangulating the job. So getting Mark full-time in that seat was critical to us developing that channel. And then on the marketing front, the marketing team is running a variety of different initiatives to support the firm, but we really wanted to enhance that digital lead gen engine, right? We want to have a channel by which people are finding us online and becoming clients that way. So that was another piece that we have been building out the past 5 to 10 years.
To cap it off, I think it's taking the approach that Chris and Darcy just talked about and then applying that to the inorganic opportunities. So being able to bring an advisor in from another RIA or institution, or partnering with another RIA, taking what we've learned, the resources that we have, and then ultimately applying those to those advisors and firms has been the force multiplier in terms of our growth. And when I look back at the advisors that have been here and their growth trajectory, a large piece of that trajectory has been built off of the fact that they can now go out to their COI, go out to their networks and tell a new story around being able to work with sophistication in a way that they've never been able to. So whether it is leveraging the sophisticated investment platform, the alternative investment expertise, or in private markets expertise, whether it's leveraging some of the resources that we haven't talked about in depth yet, but trust estates, actual lawyers on staff, CPAs, tax capabilities, intellectual property that we've acquired on the tax side. you couple all those things together, and it's been that force multiplier for an advisor or a firm to leverage those resources. And they've been able to grow their business and their client base because of having those resources around them. And culturally, it's the collaborative environment that allows that to happen. We really have, a collaboration and teamwork ethos here. It comes from the top down. And so when somebody new comes into Simon Quick, we're trying to encourage them as much as possible to leverage all of the resources that they have here. There are no quotas or sales, targets for people to hit like they do in the cross-selling institutions. But we encourage, an advisor that may not have a strong tax background to utilize one of our people who is CPA. I mean, it's a no-brainer to be able to bring that into a relationship and frankly show off.
So I'm hearing a lot of different drivers of growth in what you all just shared. Thank you. I mean, obviously starting with happy clients. If you've got happy clients, they're giving you referrals, getting the advisors out into their community to build relationships and centers of influence and sort of source their own leads. The head of client growth, which I want to circle back around to a little bit later, your marketing function, which is driving inbound lead generation, and then your inorganic. Did I capture all of the growth levers there?
Yeah, we think about it as a diversified portfolio, right? We're not focused on any one channel moving the business forward. We want them, all humming, and over time, right? One year, one of them might be a big contributor. Another year, maybe organic is a big contributor. And our expectation is that if we're pushing them all forward, then collectively the organization is going to grow the way we think it can.
Marketing is the fourth channel Chris just named, and it's the one that most firms in this space still haven't figured out how to run well. Simon Quick made a structural choice about it that separates them from most of their peer group. After the break, Darcy O'Brien walks through what that choice has looked like over 11 years, what worked, and what she'd tell any firm about to make the same investment today. Are you looking to supercharge the growth journey at your business? FICOM is ready to make it happen by serving as your embedded growth partner. Let us put our unmatched industry and growth marketing expertise to work for your business. Our strategy-first, multidisciplinary approach ensures your business goals stay at the forefront, so you're always aligning all your marketing activity around the growth you want to achieve. Visit us at ficompartners.com to find out more. The choice at Simon Quick was to treat marketing as a growth function, not a support function. That is what a chief marketing officer as a principal of the firm actually means in practice. And it's what makes the next 11 years of Darcy's work worth listening to as strategy, not just tactics. So Darcy, I want to spend some time with you because, as you know, as well as I do, we're at a lot of the same events and know a lot of the same people. It's not normal for a firm to have a robust, disciplined, fully built out marketing team with a chief marketing officer at the helm who's been at the firm for the number of years that you've been at the firm, and that is also a partner. So I think that that's highly differentiated, just to start there. And I know that your sort of journey at the firm has been one of evolution and growth. And if you were to think back to sort of year one versus year 11 in your seat, like what are some of the big learnings that you've had that others could sort of take and learn from if they're on a similar journey, but maybe a little bit earlier in their journey?
Sure. So when I think back to the early days, my role was really about building the foundation. So our website, content, email distribution lists. It was a lot of organizing, blocking, and tackling, and a lot of time spent on sales enablement. And that's still a priority for us, right? As we evolve and change, we want to make sure our people have the right materials to sell with. So that piece of the role is constantly evolving. What are the mistakes to be avoided? And there's one lesson that jumps out at me, I think about 5 years ago. We wanted to enhance our digital lead engine. And so we went out into the marketplace, we looked at a bunch of agencies, and we found one that was highly credible, that it referred to us through a very reputable source. And we made a sizable investment in running a paid strategy. And we gave it about a year or so, and we're reviewing the results, and we're just really underwhelmed with what this team was able to deliver. And I think the lesson for us at the time, there are a couple of lessons in there, but one of the big ones was really our website traffic was strong, right? The agency was successful in driving traffic to our website, but the site wasn't really optimized to capture those leads. So it was a story of putting the cart before the horse. So I think that's a lesson to keep in mind, that there is an order of operations to certain things, and making sure that our website was really able to capture leads before driving a bunch of traffic to it was one of those lessons. And another one was working with a partner that didn't really understand the RIA space. We are a funky little industry. There are a lot of quirks to the sales cycle. It's a long sales cycle, and money is a very emotional thing for people. So when you are choosing vendors to work with, you really want to be thoughtful about who you select and asking yourself, do they truly understand our industry and the people we're selling to?
And thank you. This is not a paid advertisement for FICOM, but that's what I say all the time.
It's true.
I think it's so important for, my audience to hear that from you, because there's this like knee-jerk reaction in the industry to want to go to the easy button, push the easy button, turn on paid, or start purchasing leads from the variety of lead acquisition, businesses that we have in this space, that all of my problems are going to be solved and growth is going to magically start happening from our marketing efforts. But there really is a systematic and progressive approach that you need to follow in order to find that success. And that's exactly what you've done. I love the vulnerability and transparency around sharing some of the learnings, but even if you were to go back 11 years to what you started with, that's exactly what you needed to start with to get to where you are today, which is you've built a marketing engine that has doubled inbound lead generation for the firm. So when did the success that you're experiencing today, where your marketing function, Darcy, is generating qualified leads at a pretty decent clip into the firm, like when did that start to compound, and what are some of the things that are required in order for that to work today?
I would say we started to see the results come in about 12 months into a paid program that we started running in the middle of 2024. And not to be too repetitive, but it really started with the foundation of building a custom website. So that was really important to us, doing the deep dive on our keyword strategy, our messaging, our ideal client profile, and ensuring that all of those things are really baked into the website, and then designing the landing pages or the offers that we wanted to promote, and testing and learning, right? The first 2 quarters we were running, it wasn't automatic success. You're testing different messaging in a variety of markets. So what works in your backyard may not work in a new market that you're building out. So there is an element of patience and just understanding that every time you run a new campaign, you are learning something, and that you can apply those learnings to tweak your campaigns for future cycles. And that's when you'll really start to see that flywheel come into place.
How much content do you have to produce on a consistent basis to fuel the engine?
A never-ending stream.
More than you can imagine.
I call it the content beast, and he needs to be fed all the time. We are producing content, at least 4 pieces a quarter that are aimed towards our prospects. We have 4 pieces a quarter that are aimed towards our existing client base. We have market pieces, pieces that are specific to business owners, which is a big market that we serve. So the writing, the editing, the posting, that is a core part of our marketing program.
Meg, you mentioned like year 0 to year 11. I give Darcy enormous credit for what she's built in the marketing function at Simon Quick. I mean, year zero, I don't think we knew what marketing meant. I remember reaching out to her and saying, hey, we need help. And we have all these kind of marketing related things going on. Like, I think it's time we take it seriously. And Darcy basically built the marketing function at Simon Quick from scratch and hasn't been afraid to try some things along the way and test, does this work or does that work? Let's put some budget towards this and see what the results are. Let's see what our target market likes when we, present with this opportunity or this piece of content. And it's taken, I think, years to hone what Darcy's put together, and it's really now clicking so well for us. And it's exciting to see all of her efforts and time delivering the way they are today.
You forgot to mention that when you called her and asked her to come back, you also promised that she wasn't going to be managed by Mark.
That's true. But I appreciate you mentioning that, Meg.
I loved working for Mark. We had fun.
We opened an office to get her to come back.
Just to add a little bit too, I think, the rigor and discipline around marketing is something that, Meg, you kind of mentioned, like, there's a lot of gimmicks out there. There's a lot of like red shiny objects and nobody's really figured it all out. It's a lot of trial and error and testing. And I think, some things are worthy and some things are not. I think Darcy and Chris have put a tremendous amount of time and invested a lot of time and resource around what works for us, and what works for us may not be what works for others. So I think that's part of the trial and error. That's part of the, maybe the scientific testing that we're doing, and what we found works, maybe wasn't always there 5 years ago.
And I would say part of why you want to bring that marketing expertise in-house. So you have someone who is knowledgeable, who can evaluate those tools and services that are out there, because I think otherwise advisors can be really susceptible to the strategies that are pitched to them or the tools, and it's easy to get that shiny object syndrome.
Well, it's rarely strategies that are pitched, because I don't find many marketing firms that actually know what a strategy is. It's oftentimes tactics. And to your point, Mark, there's a lot of blind squirrels in this industry that are just chasing the next nut.
That's true.
And there's a lack of discipline and commitment, candidly. It's let's try this, and if it doesn't work in 6 months, we're going to turn it off. And what you've done is not even in that universe. I mean, you committed to building a function in-house. You found the right person. You allowed Darcy the time to grow and test and learn and build. And to have that discipline commitment for the number of years that you've had it, it works. And you're seeing the results in how the marketing function at Simon Quick operates today. And I think that level of commitment is highly differentiated. I think, there had to have been, I would assume, some patience required along the way to get to where you are today.
I mean, the number of times Darcy and I were reviewing KPIs and we're like, why aren't we seeing a change yet? Why aren't we seeing a change yet? What's happening? And you just have to trust the process, right? And tweak it along the way until you start to see change in your favor. And Mark highlighted it too, is what happens on the organic side fuels the inorganic side. And what happens on the inorganic side fuels the marketing side. And what I mean by that is, Darcy's brand building efforts and the digital footprint that she's created for the Simon Quick brand make it a whole lot easier when Mark is out of the market interviewing advisors or M&A candidates that check out Simon Quick to say, hey, is this firm legit? What do they do? Are they aligned with what I need for myself, my colleagues, and my clients? And then what we do on the organic side fuels investment in the inorganic side, but also vice versa. The inorganic activity provides activities for the marketing team to promote through PR and content creation and more brand awareness. So they work hand in hand really well, and it allows us to kind of focus on both channels in a way that one benefits the other.
There is an assumption that runs through most industry conversations about high net worth marketing, which is that the wealthiest clients discover their advisors through personal referrals, and that digital channels do not really factor into how they choose. Our research suggests that assumption is out of date. 50% of investors with $5 million or more in investable assets said no referral was involved in finding their current advisor. Half of the wealthiest households in the country are now behaving more like the youngest households, researching, validating, and making their decision across multiple digital channels before they ever pick up the phone. Which means the question worth asking Simon Quick, and the question a lot of my audience is quietly asking themselves right now, is whether an advisory firm can actually build a scalable digital growth engine for that segment. Darcy has been building one for the past 5 years. We hear often, you've probably been in rooms where you've heard the objections that I've heard around you really can't build a scalable digital lead engine for the ultra high net worth client. But you're a firm whose average client size is 13 million in assets under management, and you've built an inbound lead generation and engine. How does that actually work when you're targeting that truly ultra high net worth client?
Yeah, it really comes down to thinking about who you're for. In our case, that's business owners, executives, and families with multi-generational wealth. So what these three groups have in common is complexity, right? And so our messaging and the service offering that we offer to prospects and clients is all around that sophistication, right? We have those solutions for the very complicated financial lives that they lead.
And you mentioned in your intake form that AI-driven search is a goal that you have at the business. What does that actually mean operationally?
It means reviewing our current SEO strategy and thinking through how this is changing with the adoption of LLMs, right? We are all using LLMs to conduct our searches now. And so some of the areas we're looking at is an enhanced testimonial strategy, because LLMs are looking to see how people reviewing your business. What are they saying about your business? And another one is that earned media piece. LLMs tend to value positive coverage from reputable publications. And so those are just two of the areas that we're exploring to enhance our ability to be shown up as a suggestion in those large language models.
It's just worth sort of putting a fine point on that, which is the ultra high net worth client, your target client, is leveraging search, whether it's traditional search or AI driven search, to look for businesses like yours. It's real. It's happening. It's not fictitious. It's not that because I'm really wealthy, I'm not going to use my phone. Like your client is looking in the same places, I think, that clients across all demographics are looking for trusted advice.
Yes, I would agree. And I think that it's a holdover from a time gone by where wealthy people really weren't relying on search as much. And it was so word of mouth driven. And of course, word of mouth is still a big part of how people are making their decisions. They're just consulting, the internet or an LLM right alongside of that process, right? Very few consumers are going to make a decision based off one recommendation from a friend or family member, right? They're going to do their own research because research can be done in the snap of a finger now, right? So it's absolutely no longer true that the high net worth space is not impacted by search.
I think both leads that came in the last week, I don't know if you know this or not, Darcy, but Christian Yoss is our head of client growth, told me this morning. He spoke to both of them and they both said that they went to ChatGPT and asked for, a net worth advisor that can help them. And that's how they found Simon Quick.
Those two leads are not a fluke. In our study, 15% of investors with $5 million or more in investable assets have already used an AI-driven tool to help find their current advisor. That's 1 in 7 of the exact segment Simon Quick was built to serve. And here's where the story compounds. The firms that were designed to demonstrate structural understanding of complex clients are the firms AI-driven search is finding now. Simon Quick has been building for this reality for decades, and it is showing up in the pipeline this week. Because I have such sort of a disciplined and well built out marketing function that I have the opportunity to be speaking with right now, can we dig just super quickly into some of the numbers behind it? I'd love to know what are some of the KPIs that you measure? Sort of how are you tracking the effectiveness of the work that you're doing, and what percentage of revenue are you spending today on your marketing budget?
I'll let Chris speak to the revenue side of things, but from a KPI perspective, I really take a pipeline approach. And the reason I do this is just because we're trying to reverse engineer a problem, right? The problem is we want to bring on clients. So at the beginning of each year, take a look at last year's results and start thinking through, okay, what do we want to achieve this year? Whether that's a number of, certain amount of revenue, how many clients do we need to get there? And then look at our conversion rates, and I'll ask myself, okay, if we want to get to X number of clients, how many leads do we need to bring in? How many opportunities do we need to convert those leads into in order to get to that number of clients? And then I'm looking at that. I kind of divide it by 4, and every quarter I ask myself, are we on track? And there are so many metrics that you can look at as a marketer. And certainly I do pay attention to click-through rates and things like that. But at the end of the day, why are we paying attention to those click-through rates? Because they're meant to generate leads, which are meant to turn into clients. So that's really how I try to focus on our KPIs.
Our expectation is that's going to increase meaningfully as the digital campaign continues to show progress. We're seeing early success, and there's a point at which it starts to really take off, and then you kind of fuel the engine more, and we're expecting to increase that pretty substantially over the next 12 to 18 months.
I was curious, you answered the question before I could ask it. I was curious, what should that be? What should the 2 to 3% today be in 3 years if digital is going to be a main driver of growth? It sounds like you're going to be watching closely and making bets and investing where you see it's working.
Yeah, there's really I would say there isn't a cap in my mind, right? If it's working, if it's creating leads that convert to opportunities, that converts to new clients, we will continue to invest in it. And we know that once it works, there's kind of hockey stick type growth ahead, and we're waiting till that inflection point really kicks in. And it certainly feels like in just the last 90 days we've seen a ramp up. So hopefully this is the start of that.
The patience Chris just described on the marketing side is a byproduct of a structural condition that also shapes how Simon Quick approaches M&A. When a firm is not on a forced acquisition timeline, the calculus flips. The screen becomes qualitative first, quantitative second, and the firm ends up in conversations that other acquirers just don't get invited to. Okay, Mark, let's talk a little bit about some of the learnings and successes that you've experienced that have contributed to the growth at Simon Quick. I know that you recently completed an acquisition of Proquility. Am I saying that right?
Proquility Wealth Partners, that's correct.
Yes, and I read an article that the founder of that firm was in that said he evaluated nearly 20 firms before choosing Simon Quick. So talk to me about that particular acquisition, what led you to it? What were those conversations like, and why has it been meaningful for the firm?
Great questions, Meg. I think, in our conversations with Andy Ferguson, we've come to appreciate his process for finding the ultimate right home for his clients, his team, and himself were largely driven by, I think, a shared mindset of what a client experience should look like for high and ultra high net worth clients. And looking in the marketplace, to your point, 20 different platforms. There's a lot of firms out there right now in the industry that are acquiring RIAs, and in many ways, a lot of them, they all kind of look and feel the same. that's just my frank opinion. There's not a whole lot of differentiation. There seems to be a lot of capital that has come into the industry that's trying to create and gobble up as fast as they can. That was not what he was looking for, Andy. There is certainly enough capital in the space now to provide for a liquidity event. Liquidity event was a part of the equation, but it wasn't the lead part of the equation. I think for Andy, finding a firm whose values aligned with his clients and himself and his team was really at the forefront. So the process that he went through was really less about the economics and more about all of the qualitative. Certainly, quantitative is a big part of it as well. But it had to make sense for a multitude of reasons and not just one, which was, I think for many people in the industry, and that's the quantitative side. And it makes sense, and I get it. I think a lot of firms get it. But for him, that wasn't the highest and most important.
And how did you get in front of him? I mean, Andy was talking to so many firms. Like, how did you get there to be the winner?
Yeah, it's a great story. He was represented by a consultant in the industry who I had developed a relationship with. When that consultant started their business, I had just seen the story. I can't remember if it was one of the traditional channels like CityWire, or if it was on LinkedIn, but somehow I saw it. And this was before I stepped into my current role, but I happened to see it and I reached out. It was a cold reach out and just said, would love to connect. And over a couple of year period, developed a relationship and a rapport, and, told them a little bit about our story and why we were different, from all of the other firms in the marketplace. And ultimately, it led to, a great outcome in the sense that we were able to connect with Andy and the Proquility team and, have them be a part of Simon Quick.
Now, in a similar way, because it's sort of inorganic growth driven, but a different strategy, I know that you last year in 25 expanded into a new geographic region in Texas, but you did that without an acquisition. You lifted out a senior team from Northern Trust and you really built around them. So when did that become evident to you as an opportunity, and how did it sort of fit into your strategy?
Yeah, great. Another great question. In that case, Dallas was a market that we were looking to enter. One of my partners here, Tom Moore, has a number of clients in that region. And it was something where his clients were saying to him, you really should have a presence down here. And then Tom coming back to the executive team and saying, how can we make this work? How can we make an opportunity happen down here? And it comes back really in all circumstances to finding the right people. And so we had hired a search firm to help us identify the right person. And in this case, it ended up being multiple persons. And that 3-person team, worked very closely together at Northern Trust. They had developed a long-standing rapport with each other, and ultimately the three of them decided to want to pursue an outside opportunity and endeavor together, not as individuals, but as one team. And they really, they eat, sleep, cook, breathe in threes in many ways. So it goes back to, though, finding the right people. Starting with, core values, collaboration and teamwork. You have to have the right mindset. Otherwise, it probably isn't going to work. So in this case, they also had, high net worth clients they were working with. The investment philosophy lined up. And ultimately, they saw the opportunity of being a new market presence for us as being something that was really unique. And very attractive to them as individuals. So, when we look at opportunities for us, geography, unless they're, thousands of miles away and not in a direct flight, let's have a conversation. It's really about finding the right people. Talent is the asset. And if we can acquire that asset and have that asset be part of Simon Quick, then we all win.
I think it's worth noting that you have been acquisitive and had these successful acquisitions and lift outs without a private equity backer. And that's been an interesting trend recently on growth leaders. My recent guests have included TruePoint Wealth Counsel and Coldstream, who are both growing really quickly without a private equity backer. TruePoint is not acquisitive. Coldstream is. And that just changes the dynamic. You just don't have the same pressures that you otherwise would if you had a PE backer that's looking at inorganic as a significant growth driver and you've got pressure to get deals done. So how do you think about inorganic on a go forward basis? Do you have mark that you're looking to hit every year of number of acquisitions and lift outs? Or is it very much just to your point, it's when we find the right people that align strategically with the business vision that will pull the trigger? How formulaic is it versus opportunistic? What makes Mark's answer worth listening to carefully is that it isn't categorical, it's principled. There is a difference between a firm that says, we'll never take outside capital, and a firm that says, employee majority is our commitment, and any capital decision from here forward gets tested against what is best for our clients. The second version is the more honest one in 2026, and it is the one Mark is about to articulate for us.
Yeah, I think in leading up to now, it's been more opportunistic. Chris kind of, and Darcy as well, I think not directly said it, but alluded to, it was very episodic. It was very, as opportunities presented themselves. Certainly I was spending time previously in the COO role, having a significant portion of my day-to-day being allocated to inorganic. But when you don't have somebody that's completely focused on it, you kind of know what the results are going to be. So did we have successes? Absolutely. But it really did shine a light on, well, what if we were actually focusing 100% of somebody's day-to-day on this? What could the results look like, and how could that have a meaningful impact on our overall growth trajectory as a business and as an employer? So I think, when we look at the track record leading up to today, it's been sporadic. We want to make it more formulaic. I think the last 12 months I've spent a lot of time in just telling the story amongst the community of bankers and consultants and recruiters and other search firms, not really with disciplined numbers or targets in mind. But I think, going forward, certainly we expect to do this more frequently. But, are we going to be on one of the bankers, top 10 acquisition, acquirers of the year? No, that's not who we are and what is driving us. And I think you talked about, the independent firms out there, the ones that don't have outside capital. And you mentioned some of those names. And I think, we want to be part of that cohort that people are thinking about as unique for that reason. I can't say it will be forever, but our commitment is, to being an independent firm. Will we need, growth capital or debt capital at some point in the future? We'll see where we are when that happens. I mean, every business, I think, goes through, has to assess constantly where they are and how they're optimized, as an ownership and ultimately what is best for clients. If we come to a point in the life cycle where, and I was just talking about this with a colleague today over lunch, where Les once said to me, you never want to get to a point in your life cycle where your business is becoming irrelevant. And that always stuck with me. We're at a point in the industry where things are changing, and they're changing fast, rapidly. So, will we be completely employee owned with absolutely no outside capital forever, I can't say that. But I think, a commitment to employee majority where we are in control is something that I don't see us giving up anytime soon, or anytime in the foreseeable future. I think it's more likely that, if I'm really successful, we may need outside capital one day, but that's only because we're finding the right people who are adding more and more depth and breadth and resources to our clients, and that's good for everybody.
Make two maybe follow-up points I would just make. When Mark was COO, he was spending probably anywhere from 35 to 45% of his time on identifying the right strategic partners for us. When he stepped into his current role, beginning of last year, he made the commitment to spend 100% of his time on that for us. And that's because it is such a big part of, what we think our growth story will be. And certainly early on where we've had success. To answer your question directly, I think we would like to do on average 2 to 3 a year. And that's a combination of bringing on advisors that are bringing clients with them, advisor teams bringing clients with them, and acquisitions. Last year we started the year with kind of 5 really robust opportunities in our pipeline. We closed on 4 of the 5. So it was a really robust year. So I think if we could do 2 to 3 a year, that is a pace that we can certainly handle. And also based on how selective we are with the people that we choose to partner with, because as Mark said, we don't have outside capital partners that are demanding certain rates of return or growth rates every year of us. We can be selective with who we partner with. So we tend to have, a really high bar when it comes to who's right for us and right for our team. And we're looking for individuals that need help with growth, right? And that's the point of today's discussion. We're looking for individuals that culturally align with who we are and will make us, better collectively, kind of a 2 + 2 = 5. And then thirdly, a client base that's consistent with the clients that we work best with. And, if we can find that, then there's a lot we can do together.
At most firms, marketing generates leads and helps the advisors close them. There's usually a gap between the two, and that gap is where good prospects go quiet. Simon Quick's answer to that gap is a dedicated senior role, head of client growth, that sits between marketing and the advisor and coaches both sides of the handoff. Phones are already ringing off the hook with private equity suitors who would love to invest. And now that you've stated all of that out loud, I think probably you're going to get some more calls. I want to ask one question about Christian Yoss, and then I'll circle us around to sort of wrap up. But I know that he recently joined. Well, when did Christian join? What year was that? Last year?
Last year.
Yeah.
It was last May.
Yeah. And he's in the head of client growth role. And earlier, Chris, you were talking about how big of a hire that has been, how significant for the firm, really working with coaching and training advisors. And then when we were talking about marketing, you were also talking, it sounds like Chris is taking the leads that are coming in from the engine that Darcy and her team have built. So what is the role of head of client growth? What is Christian responsible for?
Sure. I think the best way to describe it is it's nurturing every lead through the sales process and helping if someone reaches out through the website and Darcy's team identifies it, they send it to Christian, and then he reaches out to that person and says, "Hey, I heard you express interest in learning more about Simon Quick." I'm essentially the person that's going to help you figure out if Simon Quick is the right home for you and help you in the way that you're looking for help. And then along the way, he will connect that person to an advisor at Simon Quick, and that advisor ultimately becomes the client advisor from that point forward. And the other thing that Christian does, which he's doing with some of the advisor recruits that have joined, is he just helps advisors grow their client relationships, right? And, Mark might introduce an advisor to us, and they're looking for ways to grow. And during the recruiting process, Christian will sit with them and say, hey, have you thought about this? Or have you thought about that? Or, this is a strategy that I've used a lot and it's been really beneficial to me. And if you join Simon Quick, I will be your personal coach to help you grow the book of clients that you work with, not just identifying ways to find new people that need help, but also being better about communicating the value that we add to the people that you do talk to. So it's casting a wider net and then ideally increasing the rate at which, prospective clients become new clients. And he's been doing this for decades. He's managed some very large teams. We feel, really kind of excited to have him on board and to have the resources that he brings to the table, available to our team. And this is available to everyone, right? I mean, we've had more people that are not client-facing people bring prospective clients to the organization in the last 12 months because they feel confident that, we have a system and a process that nurtures them through and educates them on why Simon Quick's the right home.
That's really cool. That's an interesting take. There's a lot of discussion in the industry today around centralizing marketing and business development functions at the corporate level so that you can drive growth in the way that you want while also elevating the role of the advisor and allowing the advisor to stay focused on what they're doing. So that's interesting, and I'm excited to follow along. I'll wrap us all up with the same question for each of you. We'll start with Darcy and then Mark and then Chris. I'd love to know from each of you, what's one thing in your role that's keeping you up at night right now? Like, what's one thing that's just kind of nagging at you? And then what's one thing that you think Simon Quick is really uniquely positioned to lean into to continue to drive growth?
Yeah, great question, Meg. I would say AI is keeping me up in a good way. The possibilities that are available to us today are so different than what was possible just 2 or 3 years ago. So what I'm really thinking about, and I'm sure a lot of your listeners are in the same boat, we have a really lean and mean marketing team internally. And so leveraging these tools to become more productive, not just at content creation, is where I find myself spending a lot of time. I think it's a huge opportunity.
And do you think that you're uniquely positioned to capitalize on that opportunity because of your strategy and your approach and just how you inherently think about things?
I think so. I think the way Simon Quick is structured, it's a very entrepreneurial firm. And so I feel like I'm given a lot of leverage to play, test, see what works. And so I plan on taking full advantage of that.
So what's keeping me up at night, I'm still kind of wearing my COO hat from years ago now, is cyber. I mean, it's something that still, as a business owner of a meaningful size enterprise, like that is something that keeps me up at night. It's not necessarily my role anymore, but it's something as a business owner that I do think about a lot. Certainly in my current role, the thing that keeps me up at night is just outside capital that's proliferating within the industry and the effects that it's having. And, it's good and bad. Like many things in life, I think, there are, certainly, I think, one of the pluses is just that there's a lot of choices out there. What doesn't get talked about is just the after the deal impact. And I think for us and how we're uniquely positioned because of our current ownership structure and capital, we're uniquely positioned to be a partner that wants to grow for the future. So somebody that's looking for a growth opportunity and a long runway to be part of a collaborative enterprise where you can actually talk to the leadership team, that's a differentiator, something that I'm leaning into in my conversations with advisors. And what I'm also seeing just as a trend anecdotally is I'm seeing more, meaningfully more people on the front side, or maybe the turn at the 9th or 10th, that you're now seeing people that are more early on in their career looking at partnership opportunities. They've gone independent. They've worn all the hats. They like to be a business owner, but they don't want to be the person. And that's okay. You can still be an owner of a business and hand off some of those hats to really capable colleagues like we've done here. So I think that's, part of our differentiation.
The one thing that I think about is just, what does the future of wealth management and financial advisory look like in an AI world? And what I mean by that is, which generations will be less dependent on personal relationships with their advisors for financial advice, right? We're proud of the relationships we've built with clients and the relationships that have allowed us to grow the way they have. But certainly as the end user leverages technology more and more, there will be, I think, a point at which the technology that's available to the client base it'll change, right? It'll change the way that the advisor and the client interact. And, we think about kind of skating to where the puck is going. And that's something that I'm thinking about, right? Like what could it look like? What will it look like? Which generations or segments of clients will be most drawn to the personal relationship approach versus, leveraging technology the way I've been working with Bank of America for 22 years. And that's something that is both an opportunity for us as we separate ourselves within the market, and certainly something that we have to be mindful of as the industry changes.
And what's the one thing that you think Simon Quick is very uniquely positioned to do differently than others in the industry today?
I think our team and our culture is really special and really unique. And I know that I'm not the only one that says that about their organization. But I think in a world where AI and tech is more available to the average individual, I think relationships and people will become more and more valuable. And I feel like our team and our people really do differentiate themselves amongst the competitors. And I think our client base has made it clear that they value that enormously. Certainly, you have to get excellent advice. You have to get exceptional service. But the personal relationship piece is one that we're very proud of, and one that we're going to continue to lean into as a differentiator.
There's a version of this conversation that treats what Simon Quick has built as a set of tactics: the ownership expansion, the marketing function, the M&A model, the head of client growth role. But that reading misses the through line. Every one of those decisions is downstream of the same design intent: build a firm that can demonstrate structural understanding of clients whose lives are actually complex. 74% of high net worth investors told us that demonstrated understanding is what mattered most when they chose their advisor. Simon Quick has spent 22 years engineering that demonstration into the architecture of the firm. Toward the end of the conversation, Mark referenced a line Les Quick once said to him about relevance being the actual commitment of a business. That is the honest version of what independence is for. Ownership structure is not the point. Remaining relevant to clients whose complexity is growing is the point. And the firms that were built to do that structurally are the ones showing up now when the wealthiest investors search across digital and AI-driven channels for someone who understands them. That is the new growth equation. For Growth Leaders of Wealth Management, I'm Meg Carpenter. If the Simon Quick story got you thinking about the design intent driving your firm, the single most valuable thing you can do for this show is leave us a review. It takes 30 seconds and it helps other growth-minded leaders in our industry find these conversations. It also helps us keep bringing them to you. I promise we read every single one. I'd also love to hear what resonated with you from this conversation with Simon Quick. Please find me on LinkedIn and share your takeaways. For more growth resources for your firm, visit ficompartners.com/insights. And if your firm is ready to take marketing-enabled organic growth seriously, that's what we do every day at Ficom Partners. We'd love to talk. Thank you to today's guests, to our producers at Podpony, and my executive assistant, Kristen George. I'm Meg Carpenter, CEO and co-founder of Ficom Partners and your host of Growth Leaders of Wealth Management. See you next time.